Hi, welcome to the TopHouse Walkthrough Podcast. My name is Ben, co-founder of the TopHouse Real Estate app, where you can discover homes with short video walkthroughs by some of the top agents in your local neighborhood. Today I'm joined by Amir Parsa, who is a mortgage broker, co-founder and partner of the North Power Mortgage Group, and he has been in the industry for 18 years. I'm excited to get his take on what's happening in the mortgage market and how that's impacting the real estate market. Thanks for joining us.
Thanks for having me.
Let's get started. What is going on in the market today?
A lot. We've seen some changes in the industry in terms of like rates. Rates have gone up significantly in the past 4, 5, 6 months, I would say. We've seen changes in terms of qualifying individuals. So we've seen a lot of I would say changes that directly and indirectly have impacted some of our applicants.
Are you finding a lot of difficulty in getting new clients approved, whether that's on the refi side or new purchasers?
The biggest change that I would say we've noticed is what we call a stress test, right? Stress test, because of rates changed, rates have gone up significantly compared to where we were last year this time, where I guess on average we were about 1.5% on the variable rates, and using basically a 4.79% what we call a mortgage qualifying rate or stress test. That is the biggest change I've seen that has put a little bit of pressure on our applications. Today we are using somewhere around 6 to 7% basically qualifying rate to qualify our applicants, which has definitely put some pressure on what they can qualify for.
At the peak of the market, you were qualifying clients at what percentage?
So mortgage qualifying rate or stress test about a year ago, I would say was about 4.79%. They increased that late 2021 to 5.25%. So regardless of what rate you were getting, the qualifying rate policy says whatever the contract rate is, you add 2% to it. If your qualifying rate is less than the benchmark, which is a 5.25, then you would use 5.25. If the rate plus 2% is higher than the benchmark, that's what we're dealing today, then you would use the higher rate. Rates gone up significantly. We were at 1.5%. 1.5 plus 2% was 3.5%. So we were using 4.79 or 5.25 to qualify them. Now, because the rates are about 4.5, 5%, when you add the 2%, you're qualifying these applicants at about 6 to 7%.
Someone that was able to qualify at $1 million today can only qualify for 800,000.
Eight and change, I would say. Yes, absolutely.
We've obviously seen the market shift from the peak in terms of prices of $1.5 million, maybe in February of 2022, to today, it's just over $1 million. Do you think the majority of that price change is because rates have gone up and we've taken a lot of buyers out of the market, or is it just fear that the market is going to crash?
I would say it's a combination of both. Obviously, when markets started going up in terms of rates, that put pressure on qualifying. That if you're qualifying less, you're obviously going to purchase something that is worth less. Then obviously, not fear of not. I would say not knowing what will happen, right? So people are just waiting. There are individuals that they're either trying to time the market, they're trying to wait for the bottom to buy, which it's almost impossible to time the market. And also we have type of individuals, investors that are like completely outside of the market. They're waiting for, obviously, either they're looking at deals, are they looking at knowing that rates might change in the future. They're waiting for that. So yeah, that I think combination of both.
Why do you think it was such a surprise when interest rates started to go up?
I don't think it was a surprise. It was a surprise how fast they went up. In a good economy, rates are going to be higher. We knew at some point Bank of Canada will start raising. You just didn't know how fast they're going to start, how fast they're going to raise, basically. And obviously, oil prices going up significantly, war in Europe, that put the pressure on Bank of Canada to basically start the fight and basically push the rates higher faster than what we were thinking. We're anticipating another probably somewhere up 0.5 to 1% increase by the end of this year. Would that put more pressure on the market? I would say yes. Yes, the cheapest rates are around somewhere on the high ratio mortgages or insured mortgages. you're looking at somewhere around high threes. On an uninsured mortgages, you look at somewhere in low to mid fours, and 5-year fixed, very similar, high fours and low fives. So technically, if you look at it, they're almost double, maybe more. Yes.
Have we started to see the impact of that in most Canadian homeowners' payments?
If you had a fixed rate mortgage, fixed rate, any type of fixed rate, 3 years, 2 years, 5 years, no, because your rate is fixed, your product is a fixed product. You wouldn't see anything until your mortgage is up for maturity. If you were in some sort of a variable rate product, depending on type of the variable, there's variable rate mortgages, and there's also what we call adjustable rate mortgages. If you're in adjustable, definitely you've seen the impact. You have seen changes in your payments because they're adjustable based on where the Bank of Canada and also banks that adjust their basically rates. And if you were in a variable rate mortgages, you haven't seen the impact yet, but you might see it in a very in the next few months. On the broker channel, I would say most of the mortgages are adjustable mortgages. So whoever had an adjustable mortgage, who has an adjustable mortgage, they've seen the changes. Between the banks, most of the banks, I guess, they don't have adjustable rates. What they do have is just what we call it variable rate mortgages. Your payments haven't changed yet. The percentage, what has changed is the percentage that goes against your principal versus interest, which again, there's an argument that on the next Bank of Canada increase, we might see a massive increases into those payments. Once your mortgage hits a trigger rate, that means that you're actually not paying anything against your principal. The bank has to increase your payments. So if you have a variable rate mortgage, you haven't seen the impact in terms of the payments actually changing.
So a portion of the market has these adjustable mortgage rates, and they've been impacted already. And a large portion of the market have fixed rates, or they have to hit their triggers, which they haven't hit yet. Is there an argument that maybe the worst is yet to come?
We've never seen anything like this. Most of these banks haven't seen any changes like this. They haven't hit the trigger rate. So remember, the prime rate also impacts your other type of lendings. There's HELOCs out there, secure lines of credits. They've already adjusted. Based on the data came from CMHC, most of Canadians apparently own their mortgages are fixed mortgages. So that's why government probably is not worried as much. But at the end of the day, definitely we'll probably see, an impact in the near future for sure, right? The only fire sales are the ones that they're end users. They bought and they have to sell. Hopefully we might see in some markets, the effect of the fact that the payments have gone up have put pressure on some people, right? Definitely activities have dropped significantly, right? Number of activities have come down significantly. Some markets 30-40%.
And we've fallen into this weird supply-demand dynamic that is causing the prices to change quickly.
We've definitely seen a more of an end user deal coming through the doors than in basically I would call it investor type of applicants. 45 days was normal 4 years ago, 3 years ago, prior to pandemic. And I think we were just basically going back to what we call balanced market, which is a healthy market, right?
So are you a bull or a bear today?
I love Toronto's market, so I'm always pro real estate. But I would say when nobody's buying, it's a good time to buy.
Why are you so bullish on the Toronto market?
Fundamentals are here. Look at where we are. Government has approved about 300,000-400,000 new immigrants. Big corporations are opening new shops here. People are coming out of that, the COVID lifestyle. RBC this morning, I saw CEO of RBC saying that he wants to see more employees coming back to the offices. What does that tell you? And I think Toronto needs it needs a lot more properties. So.
Well, in 2017, when we implemented the mortgage qualifying rules and started to stress test everybody, we took a lot of buyers out of the market. We said, okay, now you have to save more down payment. Now you have to earn more money before you can get back in the market, effectively taking buyers out. And that slowed the market down on the demand side again. We've effectively done that here again, where rates have gone up and a lot of buyers have been pulled out. All of this is on the demand side. On the supply side, we needed 1.5 million new homes by, let's say, in 10 years.
Yep.
We're not building nearly as many. Toronto has had a fundamental and chronic supply issue. Do you believe in that?
100%.
There is an argument that home prices have gone up simply because there's been cheap money. And many others will say, no, there is truly a shortage on housing in Toronto. Which one do you think it is more of?
I think number one is a combination of both. I guess when things are cheap, you would spend the money. It's just a reality of life, right? On the fundamental issue here is the supply demand. The demand is there. Unfortunately, the supply is not there. And knowing what's happening today in today's market with developers pushing back projects and delaying some of the projects, this is just going to basically put more pressure on the demand side. In 2008, in 2017, 18, we had the drop, we came back. We had the drop, we came back.
If you had to bet, would you say we're going to have a quick rebound from where we are today, or is it going to be sort of a longer, prolonged, stagnant growth?
I would say it will be a different increase. It won't be like double. We won't see like those massive increases year over year, but we will see increases, which will be, I would say, healthy, normal increase in the real estate market, right?
I remember when U.S. started to go through the housing crisis in 2008. There were 40-year more amortization products, zero down, and Canada was starting to introduce some of these as well. And all of a sudden, we pulled back. From 2008 to fast forward to today, so much has changed in how we qualify someone for a mortgage. Talk to me about those changes and how that's impacted the market.
Going back to 2005, 4, when I started, until like right now, when I looked up the history, there's like 17 pages of changes that we've gone through. Yes, in 2006, 7, 8, we made it much easier for clients to buy. We went from 25 years amortization to up to 40 years amortization. Think about it, 40 years amortization. That will help you a lot when you're looking to qualify for bigger size mortgage, right? Larger mortgages. Then obviously Canada saw what happened to US. They pulled back. They made some changes. Fast forward to in recent years, 2015, 16, where we saw major changes in our industry, right? I think one of the biggest ones was like how we qualify clients. We called stress tests. Nobody knew what stress test was. We always had stress tests from at least the day that I started back in 2004-5. We were always stress testing applications. It was just a type of the application was going through a stress test. The way that we were stress testing, it was different. But in 2015, what we called Bill B20 was introduced. We saw major changes, and the biggest one was the way that we stress test everything. Pretty much every mortgage application had to go through a new stress test.
Who do you think has been impacted the most by the recent changes?
I would say, and I've been saying this for a long time, first-time home buyers, individuals that they were borderline approved. Now all of a sudden they're completely out of market applications.
My understanding is we also changed the amortization. If you're putting less than 20% down, you can no longer get 30-year amortization. Now it's 25, and that makes it even harder for first-time.
Absolutely. For applications that, as you mentioned, if you're purchasing a property, we call it high ratio, basically mortgages. If you're purchasing a property under $1 million and putting less than 20%, you are capped at 25 years amortization. The 5 years, you'll be surprised. That 5 years will help a lot of people to basically pass the hump, basically, and be approved. It's a matter of getting approved or getting declined. I think again, reading the basically news coming out of OSFIs and regulators, they are looking into changing some of the policies that were created back in 2016, but knowing how they are might take longer. Until then, we have to unfortunately use the same policy to qualify, which unfortunately put pressure on your first-time home buyers, your people that they're new in the business, they're newcomers, they're the one that they're filling it for sure.
Right. Because we implemented these rules, it effectively built a little bit of resilience in the market. Do you think we're going to see delinquencies and power of sales go up in the next year or two, perhaps because a lot of people didn't anticipate this huge rise in mortgage payments?
I think delinquency goes back to, again, which markets are we talking about, right? Type of the individuals, right? Type of the clients. Are we seeing a lot of applications? A lot of clients saying we can't pay the mortgages. No, I think Canadians are really good at paying the bills when it comes to specifically their mortgages, right? In the U.S., things are different, especially back in 2008. You couldn't walk away from your house without damaging your credit history and anything. Here, I think the last thing that we will walk away it will be our homes, right?
Right.
So I don't necessarily say, well, I think you're right to call it, I think in what we call it, is this a crash or soft landing? The reason there might be a soft landing is because we use all these measures to qualify people the past few years.
Right. Which markets do you think are the most risky today?
There's a philosophy, closer to City Hall in Toronto, the market it's very resilient and nothing changes, right? But outside, I mean, if you go outside uh, smaller towns outside of GTA 905s and 705s that people have been talking about, we see lot. They go up a lot. They come also down a lot. Uh, Again, GTA pretty solid market at the end of the day. But I would say outside of the major urban cities. That's where I'm worried about. I see a lot of it, like people paid millions of dollars for homes that I don't think they're worth more than millions of dollars, to be honest with you. So it all depends on, again, markets, but my market, I haven't seen anything like that. I haven't seen property values are dropping significantly. Activities have dropped significantly, but the property values haven't dropped significantly.
Right. There's a sort of conventional belief that home prices will double every 10 years. In the last 3 years, we've had prices double
Yes.
in most of GTA market. Now we're in this higher rate environment, less easy money. Are we in an environment where we're going to continue to see that doubling every 10 years, or is it totally different?
I think we'll be in a different environment. So depending on where you are, I think the answer could be different. Mortgage rates will put pressure on prices, I think. Are we going to see doubling up? Probably not. Are we going to see a moderate increase in property values? I would say yes, just because the supply demand issue that we have in Ontario. And I don't think this is something that we can change it overnight.
Right.
If you're part of the younger generation is buying your first home, you might think differently because you got used to seeing 1%, 2% rates. I think rates are going to stay where we probably, in high threes to fives for, foreseeable future.
Talk to me about some of the mistakes home buyers are making in preparing for getting a mortgage.
The number one thing that I see is they don't pre-qualify themselves. They don't talk to professionals in the business. It's either a mortgage broker, financial advisor, bank, mortgage basically advisors that they work for banks. The first thing that you do, you need to talk to us. We need to run the numbers for you. We are in an environment that, honestly, on a different day, we might give you a different answer. Now, I'm not saying on a daily basis, but somebody was pre-qualified 6 months ago for a certain amount of certain amount. They may not qualify for the same amount right now because of the way that mortgage industry is moving, right? A good real estate agent, and I work with many of them, they tend to have their clients contacting us first, specifically on first-time homebuyers, people that they've never done this. They want us to, run the numbers. They want us to make sure that, they understand what they're doing and, tell them how much they're qualified for. So that is the biggest thing. Like they're not preparing themselves for the biggest investment of their lives, basically. One of the biggest issues that we've seen in recent months and years is people cannot prove the source of their down payment. You're in Canada. A lot of us we have migrated here. We are immigrants, right? If money's coming from your back home, you have to be able to prove it. This has been a big problem. Right? We always tell clients, when you're buying a property, do not add any sort of extra debt while we are working on your applications. All of a sudden you have a massive lease payments, massive loan payments, I tell people, please do not. You want to do anything, do it after you purchase your property, right? That could basically jeopardize your application. Any sort of debt payments could jeopardize your application. Often they forget about some of the debt that they have. Hence why when we do a pre-approval, we want to see everything up front. If we see a red flag, we prepare them for basically a future purchase, right? We tell them, hey, you know what? Yes, you have a couple of loans around. Maybe you can consolidate these loans, right? Bring the payments, re-amortize your loan. Smaller payments will help you to qualify for bigger, basically, mortgages. Right. So if I want to talk about like scenarios, there's tons. There's tons, right. Unfortunately.
So obviously, you work with a lot of real estate agents as your referral partner. What recommendations would you have for them to help them be more successful in getting deals done?
If you talk to a very successful real estate agent, they have a team of people around themselves. And usually a professional is one of the top guys and part of the team. My basically, only suggestion is get your clients in front of a mortgage professional right away. What do you think? I want to see your documentation. I want to see, often we see, clients telling you they make $100,000 a year. When you look at the actual application, actual documentation, we only see $75,000 income, right?
And it's a really good point you raised with regards to the income and checking it, because now the banks want to see all the notice of assessments and the T1s. Someone might think they're making X amount, but with deductions, and maybe they're self-employed with deductions and maybe their dividends, and they're not consistent, and then all of a sudden the bank doesn't qualify or count that as income, consistent income, and you just don't qualify.
But hey, you actually one of the biggest problems that we have is it's an income part of it, right? There are individuals that they do earn money. It's just when it comes to taxation, they don't show the real numbers on their basically personal taxes, right?
It's not just your income and your application. Well, at the end of the day, also what matters is the property. So
yes,
maybe there's high maintenance fees, maybe it doesn't appraise.
When I advise my clients, I'm like, listen, look at your papers, look at your scenario, you are fully qualified. However, one thing that we don't have is the security, is the actual collateral, is the property. That what if the property is not appraised? What if the type of the property? What if the property is too small? Often we see in this day and age that builders are building properties that are under 400 square foot. A lot of lenders won't even touch those sort of like type of properties. So it's not like just because you're not qualified. No, you're qualified. The type of the property doesn't fit the guidelines, right? So it's extremely important to know what we are dealing with. That's why when I'm talking to clients, I ask them, what type of property are you looking for? Have you seen anything that you like? Send me some scenarios, send me some properties, and I'll basically model the application based on that.
The government recently introduced a program, CMHC, where they will invest with first-time home buyers in their equity. Have you done any mortgages with them?
None, zero. To be honest with you, based on what I'm reading, talking to folks in the business, no one liked it.
We spent a lot of taxpayer dollars, and ultimately for something that isn't really being used.
Yeah, the program was designed for small town. I to be honest with you, because of the way that it was, the way that they were qualifying individuals, the way that they were running the numbers. In big cities like Toronto, Vancouver, when your property value, and I know they tweaked this around a couple of times. They increased the, a threshold, the down payment, stuff like that, but still wasn't good enough because properties were too expensive for that program, basically. Knowing that rates are probably going to stay high for at least next few years, in order to help at least the first-time home buyers, I believe we need to extend the amortization on those type of applications. I'm not saying extend the amortization on what we call uninsured deals, but I think one of the ways that we could do this is to extend the amortization on what we call high ratio mortgages. Primarily first-time homebuyers, that they're the one that they put less than 20%, or what we can do is revisit the stress test.
That's fantastic, Amir. Thank you so much for doing this, and I look forward to doing it again. Once again, Amir Parsa from North Power Mortgages.
Thank you, Ben. Much appreciate that. Go Top House.